Over the last decade, massive Wall Street asset managers have wrapped themselves in socially conscious marketing, heavily promoting their commitments to ethical investing and environmental, social, and corporate governance. Yet these same firms rarely turn away a lucrative contract just because a client nation skips holding meaningful elections or enforces the death penalty for homosexuality. There's simply a lot of money to be managed in these regions. State-owned investment pools, known as sovereign wealth funds, control roughly $10 trillion globally. While much of this is handled in-house, they farm out significant portions to external managers, including a sixth of Saudi Arabia's public investment fund and over 3/5 of China's international assets. To find out which firms are managing this capital, we can look to the United States Securities and Exchange Commission, which requires strict regulatory disclosures from financial institutions operating within its borders. By parsing the SEC's required Form ADV filings, we can attempt to track these numbers and map exactly how much autocratic money each major asset manager is holding. Mapping these flows would connect Wall Street's public marketing directly to the specific clients on their balance sheets. Tracking this capital is complicated by the fact that global asset managers rarely operate as single, coherent brands on paper. Franklin Templeton, one of the world's most recognizable investment managers, serves as a clear example of this internal complexity. Their UK arm is a wholly owned subsidiary of Legg Mason Global Holdings, which is partially owned by Templeton International, which is itself a subsidiary of Templeton Worldwide, eventually rolling up into the US-listed mothership, Franklin Resources. Extracting meaningful data from this structure requires locating 29 entities that appear relevant, downloading each of their individual Form ADVs, and totaling the numbers to find $66 billion in segregated sovereign wealth fund assets. This specific architecture of nested legal entities fragments data and obscures a firm's total financial exposure. Expanding this search to the world's top 20 asset managers reveals the limits of the SEC's geographic reach. BNP Paribas, headquartered in France, illustrates how massive foreign firms effectively bypass full U.S. transparency. This chart compares their total global assets, roughly 1.6 trillion euros, against the tiny fraction managed by their U.S. entity. Of that $48 billion in U.S. regulated assets, only $25 billion is traceable to sovereign wealth funds. Because regulators cannot force global parent companies to disclose their international books, borders act as a legal shield, keeping the majority of this capital off the American regulatory ledger. Even when tracking a U.S. entity, the SEC's own categorization rules provide a way for managers to legally mask their holdings. Form ADV Item 5D instructs managers that if a client fits into more than one category, they should select only the single category that most accurately represents them, to avoid double counting. Vanguard applies this directive to categorize each of its 228 clients and $11.1 trillion as investment companies, erasing the specific footprint of any sovereign wealth funds that might be investing in their index funds. BlackRock provides a similar challenge by blending sovereign wealth funds into a broad bucket of official institutions, alongside central banks, government ministries, and multilateral agencies. This bureaucratic taxonomy allows specific, controversial autocratic funds to vanish into generic, untraceable statistical pools. This chart shows the visible result of our search. Aggregating all the data across the top 20 managers reveals just over $1 trillion in sovereign wealth fund assets, but it is a total riddled with holes from missing international and pooled fund data. An accurate, open-source audit of Wall Street's autocratic ties remains impossible. These gaps in our count are a product of a financial system built with systemic blind spots. The labyrinth of subsidiaries, pooled funds, and jurisdictional loopholes allows asset managers to profit from autocratic wealth while maintaining their socially conscious public image. The opacity is the point.